Welcome to the Brain Wealth Podcast with your host, Bryan Repple. Bryan, it's been a while. Good to see you.
Great seeing you, Bill. Glad to be back here.
Yeah, well, you've been traveling a lot. I know you're attending a lot of meetings. I'm wondering if you have anything to share, report on, give us some insight. What's happening in the financial world?
Man, things are rapidly changing. I came into this industry in 1998. Okay. So I've been around it for close to 26 years. My father started the company in 82. So this is all I've ever been around is the financial industry. In the last couple of years, it is really this last year with all the AI. I've attended multiple AI conferences.
Yeah.
And seeing all this new technology that's coming out. And I know it scares a lot of people. And I think that scare part is more the uncertainty of what is this thing. And I think it's really learning to embrace it, because I think what's going to happen is what I'm seeing is in the financial services industry, it's actually I expect it to provide a greater value and a better experience for the client. So we can serve better. We have better communication, and it's allows the client to ultimately live their life, and they can go do what they're wanting to do. And through all this new AI technology, I think it's just going to create a greater experience for our clients and for our teams. So really excited what's going to be going on out there.
Yeah, it is interesting. The world is divided over this whole AI thing, with some people being terrified of it. Some people, like a guy I know who is in the financial services industry, he's like, I, for one, embrace my AI overlords. I can't wait to see what they have in store for us, which is his way of basically saying, you know what? These are really interesting times. A lot of what you just said, and I think a lot of things are going to be good. And things do, in fact, seem good. The markets are up. I mean, what's going on with that? How do you navigate it? I know this is a weird question, but, I was looking at my portfolio last night thinking, I'm doing really well so far this year. I'm doing great. And I mean, in the past, we've talked about how you need financial checkups with your advisor to make sure you're positioned correctly. What are your thoughts about what's going on in this market that seems almost too good to be true?
Sure. And so, I let's just go back and think of if it was 2008, summer of 2008. This is before the October beginning of the crash.
Oh yeah,
everything seemed great then too. As we're doing,
but you know what? I mean, I want to interrupt you for 1 second just to give you an argument back. Because I was covering business and financial news at that point. And I remember at the beginning of 2008, I was pitching stories about how you could get $1 million, $2 million mortgages with no money down. So that it felt like there was like a fundamental flaw somewhere in the scenario. I'm not sure where the fly in the ointment is now.
Well, I'll share with you is as we're filming this today, the Dow Jones just hit the all-time new high yesterday.
Yeah.
At 40,000, all-time new high. And I'm going to give you an example here, is because your question was, what do you do? How do you navigate?
Yeah, how do you navigate this?
And then so the navigation is saying, if you were going to go take your family on a road trip and you're going from Florida to California, and you just put everybody in the car and say, let's go. Then all of a sudden you're listening to the radio, and out in the distance, you see a really dark cloud coming.
Yeah.
And you're like, the news is starting to say, hey, there's a hurricane coming or a big storm's coming. And you're like, wow, maybe we should check our tires. Maybe we should check our windshield wipers. Maybe we should check. No, you want to have checked all those things before the storm comes. So you know how to navigate when the storm does show up. And so I think a lot of people, this is the time to begin doing the checkup to say, how are we going to navigate any new changes that come? Because things do get too extended. So let me give you the example of kind of what's happened here, because we're in uncharted territory. We've done things because of COVID in the last 2-3 years that we have just never done before. Yep. So let me give you an example of, let's just say in your city where you live, Bill, you had an individual that knew how to make money. Now, that's illegal. I'm not encouraging that, but they knew how to make and print money. And that individual goes and starts making money, $100 bills. And with that these $100 bills, he passes out to his mom. And the mom gets a cleaning lady. She goes out and buys new furniture. She starts buying new stuff. He prints more money. He goes to the local gambler in the city. He's gambling with that money. They go out and buy groceries. This new money gets put in circulation. All the recipients of this money, they start buying things.
Yep.
Because this is all new money that's being created. Well, eventually, this city starts populating. It's booming. Things are thriving because new money was created out of nowhere until the feds come in and say, we got to bust this racket. They bust the individual that was printing the money, and then they start taking all this counterfeit money off the table, and then the city dries up. Well, that's kind of the moral of the story. That's what's happened in our economy. We've printed trillions of dollars. We've seen inflation, and now we've got this overextended market that's continued to increase, and it may continue to go. This is not giving investment advice or predicting where things are going. It's just looking at the data. And so, I think it's looking at so the question with that is, what do you do? Well, one, looking at your portfolio, go and having a checkup with your advisor.
Yep.
And I'm going to give you another example here, Bill, is one of the things that we have been working harder on. I've spent the last 4 years trying to solve a question in my head of saying, let's look at this. In 1955, Ford introduced seat belts for cars.
Yeah.
And what they showed was the data they had gathered that said, by adding seat belts to your car, this can reduce the chance of death by 70%. Now, what would you think if you knew that if you had this instrument in your car called a seat belt in the 1950s, and it would protect you and your family from dying? What do you think the percentage, the ratio would be of individuals say, I want to add that feature? Do you think it would be really high or very low ratio that individuals would say, I want?
Well, I am unfortunately influenced by immediacy bias because nobody in my family ever used those seatbelts, and I was a kid rolling around in the back seat of a Ford station wagon with nothing and no protections.
We were the prodigies of the 60s, 70s, and 80s.
Yeah, exactly.
Well, what's really interesting about that question is only 3% of the population adopted the seatbelt initially.
Yeah,
3%.
Actually.
That means leaving 97% exposed to the risk of death or critical injury. And it took decades for the seatbelt to become widely accepted. So I say this example of the seatbelt because similarly, we want to have seatbelts or financial instruments on our investments that act as a kind of a safety net in the event of an economic crash, not a car wreck,
right, but
an economic wreck. And if anyone can go back to the emotional feeling of what 2008 felt like, or in 2022, I think was a little bit more adoptable because it just came out of COVID. People had like, all right, we understand this. And we just printed money and things got, took off again.
Yeah.
So our goal, one of the things that we really strive for is, because I've gone through 2000, 2001, 2002, 2008. And these events can have a massive impact on families and on their income, their health.
Oh, yes.
So we want to really make sure that, we want to make sure that we've had the conversations. And, previously getting on this call, you and I had spoke about this conversation here today.
Yeah. And
one of the strategies that we're really looking at doing now, again, this is not investment advice. We're not going to get into details, but I like to call it. Now, Bill, I'm going to give you an example here.
Okay.
Another example. I'm in example mode today. I think giving context to things really help.
Oh, no, big time. Yes.
Now, have you ever in your kitchen made a smoothie or a drink, and you put all this work into it, and you're like, wow, you're really looking at this drink, and then all of a sudden you spill it over.
Yes.
You spill it, you're like,
or you forget to put the top on the blender when it goes everywhere. Yes.
It's a mess. And you're like, oh my gosh, I worked so hard to put this thing together, and I just spilt it. Well, what do? Well, you go out and get napkins, or you go get a sponge. You get something to absorb up the mess. You just don't leave it out there.
No.
You don't make it messier. So you get something to absorb the mess. And what I've been working hard on for the last 3 to 4 years, and this is part of the traveling I did during COVID and really more in the last 2 years, was trying to find strategy. Now, I will say as a firm, we have spent easy over $200,000 plus looking for alternative strategies that can help provide a sponge strategy to our clients' overall portfolios. Now, what would that sponge strategy mean? I use the line, either you buffer it or you suffer it. Meaning, what if you could have a sponge that absorbed a portion of the market downside, and you get to select what did you want to absorb? Did you want to maybe absorb 10% of the market downside, 20%, 30, 50%? How much of the market downside would you like to absorb that you're not exposed to in the event that was to take place? Call that a buffer. And without that buffer, if you don't have that buffer, that other word was, then you may suffer. So,
well, wait, I'm going to stop you for a second, okay?
Yeah.
Because one, we've got a sponge strategy. Then we've got the buffer or suffer sort of notion, which I'm grasping this to a certain extent, but I've never heard of this kind of I've never heard of any strategies or investments that would allow me to do this. So what are you talking about, Bryan?
Yeah, I know. I spent the last, like I said, 4 years traveling, and I was really working hard through education, courses, training, to put these type of financial instruments on our investment portfolio so we could help strategize. I always say when the markets are going up and the economy's rising, everyone is winning. It's a good feeling there, and that's nice. It's when things reverse, that's when the pain sets in. And sometimes we have to use things with numbers. So, Bill, if someone had a $500,000, $1 million or more, they worked hard and they saved and this is their nest egg. Yeah. And it's grown the last 3 to 4 years to, hopefully it's grown and they've done well. But now let's put context to it. What would it feel like losing $100, $200, or $500,000 of that investment?
Painful. Okay. You say it's painful. Yes.
And now, more importantly, what stage of life are you in when that's happening?
Yeah.
Are you approaching retirement? Are you in retirement? Are you, where are you when that event does occur? And I understand because going through 2008, 2001, 2002, that question is arising again. So individuals are not alone, and we understand these concerns, which is why I was looking for, trying to discover financial instruments that would allow the protection, the buffer, to say, hey, we're going to buffer, we're going to sponge a percentage of this downside exposure and still allow, if there's growth, if the markets are still moving forward and up, great. We can participate in that. But let's make sure we have strategies that allow us to absorb that downside if or when it does occur. Again, this is not advice or recommendation that markets are going to crash, but I think history looks at things and says, well, we printed a lot of trillions of dollars.
Yes, we did.
We've increased interest rates over 20 times, I think 21 times. We've done that. We have inflation. Anyone that goes to the grocery store will tell you, what's the cost of eggs? I mean, they used to be very cheap. Now they've gone up. Everything is more expensive. So,
I kind of stop you for a second because I mean, this is old financial, talk. For a long time, people would say you got to set a stop loss, right? So, which is a way of, buffering yourself. You buy stock and you say, look, if it falls 10%, just sell, right? So I'm getting from what you're talking about a strategy that I know you don't want to get into detail here with, because this involves individuals and this involves a one-on-one conversation. But But are you talking about something different from just like a stop loss kind of trigger?
Yeah, we are. Absolutely. And what's even more interesting about what I'm talking about is it's not using even insurance companies. See, insurance companies have been the solution for a number of years.
Yeah.
Using programs such as like a fixed annuity, a fixed index annuity, and those things have offered a solution to the downside and with some upside potential. And so, but the downside of using these annuities, which we have in with our clients in our practice, is that you tie the money up for a period of years with the insurance company, but it does offer that downside buffer. What's nice about what I'm speaking on is these are not even annuities, so we're not even using insurance companies as part of this strategy here.
Oh, okay.
And so, yeah, it is using, these are financial instruments that wrap around stocks, indexes. When I say an index, the S&P 500, what the stock market is measured after. Gold, for instance, could be an index. So we can use various investment indexes. Again, not recommendation or advice, because it will be per what's right for the individual. But that's what's available are these strategies that say, hey, we can measure your upside performance based upon what you may like from a stock or a growth standpoint. Yeah. But more importantly, you can choose what type of sponge or buffer would you like to have on the downside? What would you like to have absorbed that would make you feel good? 10%, 20, 30, 40, maybe up to 50%. And those strategies are available. We've worked hard doing a lot of due diligence, and we are just now implementing this into our practice. In 26 years of being in business, this is probably one of the more exciting times for myself, because I know we're going to be now having a conversation around a solution to say, when that storm cloud comes, you're going to be resting easy at night. We want you to be able to sleep and continue to live your life abundantly and know that, hey, we can ride through the storm. We're prepared for it. And that's the conversation we're really setting up right now to have.
Okay. I've heard enough. I'm ready to have the conversation. What about folks that are listening to the podcast today who want to have that conversation with you and who are clients already? How do they get a hold of you, Bryan?
Yeah, absolutely. One, go to the website, Repple, REPPLE, wealthgroup.com, and you can go to the calendar link there, get on our schedule, get on the calendar, and we will set a 20-minute call. If you're a new client, if you're an existing client, please reach out. Our team is here to serve you. And, Bill, I was going to say, one of the things about the AI world, I think that's going to be very unique, and this is what I'm excited about, is over the last 2 weeks, I stayed at Marriott resorts. One was a Ritz-Carlton, and one was a Marriott Courtyard.
Okay.
Very same brand, same parent company. Two different experiences. And this is the value that is going to create the relationship and experience for the end user, the client. Is one, I walked into the Courtyard, they didn't know who I was. It was no really great experience. I went to my room. I bought what I paid for, a bed. When I got to the Ritz, I got to the room. My name was on the TV. They knew who I was when I walked in. Wow. They knew what I liked. And it was like, wow, they knew me. And that's the beautiful part about this technology, is that we're going to be able to provide greater experiences. And it's the experience of the relationship, but as well as the experience so that people can live life. And when the storm does come, they're able to ride through it. We're able to say, we've got you. You're in good hands here. So yeah, reach out to repwealthgroup.com or our team. We're always here to serve you and answer those questions.
Yeah, no, that is fantastic. This has been an interesting and intriguing conversation. For those of you who have never listened to the podcast before and you're listening now, why don't you become a subscriber? Because that part's really easy. You just reach out, you hit the follow button, boom. Then you're a subscriber, and every time Bryan drops a new episode of this podcast, you're notified and you can listen to it. I would also ask that if you like the podcast, if you find it interesting, tell people about it. Share it with folks. Word of mouth is a tremendously welcome promotional tool, if you will. And it's good stuff. Thanks so much for listening today. I'm Bill Tucker on behalf of Bryan and everybody at Bryan at Repple Wealth. Thank you for listening. And I will remind you that you can go out today and make it a great day. Or not. It's up to you. Have a good one. Until next time.